Greetings, it's time for our monthly monetary creation update, and some major events have transpired within this subject matter about how reduction of cumulative money printing, quantitative tightening, deprinting, whatever we choose to call that, was never a sustainable thing because it was tantamount to going backwards on a highway. And remember, a highway, at least in the United States and many other countries, is one where you cannot go backwards or even stand in place. For example, in the United States, most highways have a speed limit of 55 or 65 miles per hour as a maximum, but a less frequent sign is the minimum speed limit. You have to drive at least 40 miles per hour. If you drive at slower than 40 miles per hour, the police will also give you a ticket because you are slowing down the entire speed of the highway and causing too much inconvenience to too many of the other travelers. The same concept applies to monetary creation because of the need to offset technological deflation with money printing, which is also why money printing has to be exponential and ever rising. It also has to be more diffuse, but we will talk about that later. This is the Federal Reserve cumulative balance sheet, the amount of money printing that the United States has done. Of course, the United States is only a fraction of the entire world's money printing. And you see this exponential trend like one would expect. The Federal Reserve keeps thinking it can tighten, and every time it tries to tighten, it has to reverse. Like here, and also here. Now, if you can see this exponential trend, then why would anyone deprint at all? Because you're going to be forced to revert back to this trend, and that is exactly what has happened. Despite this puny quantitative tightening to the tune of $95 billion a month, a bank failed, Silicon Valley Bank, which you can read about in this card up here that I have produced a few days ago, and therefore the Federal Reserve had to intervene to bail out this bank, and money printing has resumed even in the US. It had already resumed in China and Japan, as we shall see. So we go to the 5-year version of this chart. See, this was the maximum QE amount. They tried to reduce it yet again. And as they say, the definition of insanity is to repeat the same thing many times and expect a different result. They tried to tighten because the PhD economists at the Federal Reserve have all read the same textbooks that were written 70, 80, 100 years ago, and they refused to consider that the world might be different, or those textbooks may not have had the advantage of knowing what we know now. And of course, money printing had to resume. Now look at this 1-year chart. All this quantitative tightening got reversed in one fell swoop. In just 2 weeks, the United States has done $400 billion of printing again. And this is a type of printing that goes directly to people to a greater extent because it was the cash balances of the technology companies that kept their bank accounts at Silicon Valley Bank, and tech company bank accounts pay for the payroll of those tech companies. So this is getting closer to the cash directly to people type of situation that I believe is what all market forces are going towards. Yes, this was merely a preservation of bank account assets, but nonetheless, the atom is intelligent, and it has created conditions that force the clueless Federal Reserve to bypass their extremely inefficient Treasury and MBS buying to create a more direct form of money printing. All those PhD economists don't even know what is going on, but the atom is intelligent because it is part of the first principles of the universe, and it is making these market forces manifest more directly now. And again, this is just the US, and this is in the March data, which is not in the Yardeni report yet. That is only updated through February for the United States, so it'll take a month or two before I have the whole world's March data. But now in going to the Yardeni report, we can see that money printing is already rising for China and Japan. This red line represents the United States, which we just saw, and as I mentioned, does not include the March uptick yet. That will be registered next month, but this grand total is already rising. Remember, the United States is only one of these big four central banks, and therefore just a little over 1/4 of the entire world's money printing. So when people say that the United States is printing money and therefore the price of gold will rise, that's crazy because they have revealed that they are assuming the United States is the only country in the world. A very common mistake that a lot of these US inflation fearmongers often make. So if you add up all of these four together, you get this total, which is the important chart. It is only updated through January because the People's Bank of China is getting later and later in the reporting of their data. So we won't have the March data for People's Bank of China until 2 months from now. So this grand total is only updated through January, but nonetheless you see this uptick. All this de-printing to undo the supposed one-time stimulus from COVID-19 crisis management is not even being allowed to be undone. We are reverting back to printing because this exponential trend is the natural rate. Like I said earlier, that was for the US. This is for the worldwide total, which is the most important one because technological deflation is borderless and worldwide. Therefore, only the worldwide total matters. We had a situation before March where the US was doing their puny little tightening while China and Japan were printing more money too. But now even the US has to print money because China and Japan printing money did not prevent US banks from collapsing because the US has an inverted yield curve that China and Japan printing cannot undo. So the US has to print money too. And even this January number reveals a distinct uptick, and by March it's going to be much more pronounced still. This makes complete sense once you recognize this exponential trend. This is a mystery only to people who think all money printing was an aberration and that things should naturally go back down to zero, which is insane. If you think that, you're a flat earther. PhD economists are flat earthers of economics and finance, although they're not as bad as these gold bug hyperinflation people. They are even worse than the PhD economists, as I explained in other videos. And what is the percentage year-over-year growth? Remember how I often say that the year-over-year growth rate has to be within a 16 to 24% equilibrium? That has to be the annual compound growth rate of money printing just to offset technological deflation. And to be at minus 10%, which is what this misguided tightening had achieved, is quickly being reversed because this was too far from the cruising speed. This was, once again, going backwards on a highway. And when you go backwards on a highway, there are bad things that happen, and this will revert back to the equilibrium band pretty soon, even though this will be a mystery to the actual economists making these decisions. The atom is intelligent and is shepherding these economists into doing the right thing, even though these economists don't know why. Now, if only these economists did the right thing before crises rather than in a reactive measure to various crises that they themselves create. But no, we don't live in a world that works so well because we don't have the right type of people in important decision-making positions. So this is going to revert back to its natural growth rate as it should. That necessarily means many trillions of dollars more have to be printed in a relatively short time just to intercept this zone of the chart. In this chart above, that would mean 6 to 7 trillion more, getting us up to over here, because by a year from now, the trend line will be way up here. This is an exponential curve, remember. And lastly, consider the amount of money printing in proportion to the GDP of each country. That's why it's beyond silly that everyone blames the US Federal Reserve for printing too much money. It is the joint lowest of the four in relation to the size of the US economy. China is equally low, but Europe has done twice as much money printing as the United States. Europe, the European Central Bank run by Germans, you would think Germans are the people most afraid of hyperinflation, but they've still printed twice as much money as the United States. But even they're outdone by the real heroes, Japan, which has done 4 times as much money printing as the United States in proportion to the size of its economy. Now, GDP is an annual measure, and this is a cumulative multi-year measure, yes, but when people in the United States scream about money printing, again, they reveal that they think that the United States is the only country in the world and have no awareness at all of how much Japan has done. And nobody claims that Japan has high inflation. That's why these people simply don't know what's going on, because they're unable to explain why Japan can print so much money and not have inflation, yet I have just explained why. It's all borderless and tied to a worldwide technological deflation, which offsets this monetary creation. Now we go to my decade scorecard. At the start of the 2020s, all the PhD economists in the West, mostly in the US, believed that the cumulative money printing up to that point would eventually be reversed over the 2020s, because they still think each instance of money printing is somehow a one-off. It's clearly not a one-off. There is an exponential trend of technology that, as I explained, is the first principle of technology and economics, mutually reinforcing exponentiality. And therefore, the economists who believed that the first 23 trillion would be undone by the 2020s, by definition, thought that the 2020s would represent a deprinting of 23 trillion. Deprinting, a reversal of money printing. Whereas I said, and everyone knows this, and it's on this channel, at the start of the decade that the 2020s would have $50 to $100 trillion of money printing. 100 trillion if they do it in the form of bond buying, which itself is unsustainable because it's too narrowly concentrated and distortive. But 50 trillion if they do the right thing, which is send cash directly to people, as I explained in the Atom publication. People who don't understand what I mean when I say send cash directly to people, they should read the Atom publication before making a comment over here that claims this is socialism or something, because that is annoying, let's say, because you have to read the Atom publication as a prerequisite to understand why money printing has to be exponential. No, it's not socialism. I describe how income tax should also be zero simultaneously, and it's very, very obvious. People are worried about artificial intelligence taking away jobs, but they don't think about the flip side of such a fountain of productivity is, hey, all taxes could be paid by AI. We don't have to tax humans to fund government anymore. But read the Atom publication for the details. So 50 trillion if cash sent directly to people, 100 trillion if bond buying, but this bond buying itself is breaking, so I'm going to go with cash. And how much has actually been done as of March 25th, 2023? More than 3 years into this decade, $9.2 trillion. So the first 3 years of this 10-year period have led to 9.2 trillion of printing, which is the more likely outcome. That the grand total is going to be minus 23 trillion, meaning 32.2 trillion reversal of money printing, or that the grand total is going to end up almost exactly where I say it is, in this range, because in the first 3 years we've done 9.2 trillion. And even if COVID-19 was a crisis unrelated to monetary situations, it merely forced money printing to revert back to the trend line, because even now they're unable to deprint and are being made to print back up to the trend line by events unrelated to COVID that are 2 to 3 years after the COVID-19 crisis. So how much inflation does this money printing cause, and does it cause any aberrant amount of inflation? For that, we go to part 2 of this video. This is going to be our monthly inflation update for February of 2023. And inflation continues to be in the news, whether warranted or not, because inflation sells. The media makes a lot of money by making you angry or frightened, and inflation is a very good way to make people angry or frightened, because when you go to the store, you see that a few prices are higher relative to what they might have been a few years ago, but people don't consider their salary gains to be anything associated with inflation, or if they own a home, their home equity gains. Somehow their home equity gains are because of their own intelligence and not a function of the ambient inflation. That is why deflation would be very bad for society. Yet the United States is reaching a point where a lot of people think deflation will be good because the media told them inflation would be bad, therefore they think deflation would be good. And this is going to test democracy, because if voters vote for deflation, then the system is going to collapse. So this is going to be a frontier test of democracy. But now on to our scorecard. As longtime viewers are familiar with, I say that inflation is not higher than optimal until all three of these metrics are above 3% a year. And the optimal inflation rate would be for all three of these to be at 3%. Too far below 3% is also insufficient inflation, which causes economic sluggishness, the risk of deflation, debt defaults, and things like that. And these three metrics are the U.S. Consumer Price Index, 10-year compounded annual growth rate, to smooth out the short-term noise. Then the most important metric of all by far, and rising in importance, the Goldman Sachs Commodity Index. This is unriggable because it is a composite of commodities that are A, priced worldwide, and B, traded freely every day. So all these things you hear about how the US CPI is deliberately measured incorrectly to suppress the real inflation rate, that is completely bogus, because the Goldman Sachs Commodity Index is unriggable. It is unriggable and it's worldwide. And then the third measurement is the 10-year US Treasury yield. This is more an expectation of future inflation rather than a measurement of past inflation, but it is unrelated to these other two. So when you combine all three of these, you have a comprehensive multi-dimensional measurement of what inflation is. And all three of these have to be above 3%. If one is above 3%, but another is well below 3%, that is still not high inflation. It's not even optimal inflation. The optimal would be if all three were exactly aligned at 3%. And that is a certain elegant symmetry to it. But unless and until all three are above 3%, I'm not going to say inflation is too high and that money printing needs to be dialed back. The reversals in money printing that some central banks do tend to always backfire, and they end up having to print more money for the reasons I explained many times on this channel. Technological deflation is exponential. So let's go to the Goldman Sachs Commodity Index first. Goldman Sachs Commodity Index from Standard & Poor's, the 10-year compound annual growth rate is minus 1.85%. That is a long way from plus 3%, minus 1.85%. Oil is in deflation. Gold has failed to rise for 12 years. Oil crossed $100 a barrel in 2007 and 2008, and now it is only $66 a barrel. There is no commodity that has risen substantially in price relative to 10 years ago or even 15 years ago. Goldman Sachs Commodity Index is in deflation. I believe we're at a point where the technonomic medium of the world is now so powerful and so advanced that commodity prices can never catch up to a 3% a year inflation trend line. I'll do a video about that at some point as well. But minus 1.85%, far, far from plus 3%. Now we go to the 10-year U.S. Treasury yield. The 10-year U.S. Treasury yield is 3.395%. So this is above 3%, but it's come down a fair amount. It was actually touching 4%. It's come down to 3.395%, so slightly above 3%, but it cannot stay high for very long because that then correlates with a housing bust and a real estate crash in the United States. So 3.395%. Lastly, we go to the U.S. CPI. The BLS.gov website will be in the description box below, but this is the US CPI, and the 10-year compound annual growth rate is calculated by taking this number, 302, divided by the number exactly 10 years ago, which is 232, and then the 10th root of that. I've demonstrated the mathematics of how to do this in prior monthly editions of this video, but the 10th root of that, and I will show you what that is. That comes out to about 2.7%, below 3%, but the 10th root gives you the annual compound growth rate. And as you can see, this 1 month percentage change has already moderated down. Same for the 2 month percentage change, 3 month percentage change, 6 month percentage change, and this 1 year percentage change is already drifting down. It's not plunging like a rock, but it's drifting down at about the same rate that it rose up. Now let us go to that table that I introduced a few months ago so that you can see what the annualized numbers are for all these different time windows. Plugging all of those readings into this table gives us the annualized CPI growth rate on a 1 month window, 2 month window, 3 month window, and 6 month window. And you can see all of these are in the 4s and 5s range, which is above 3%, but still quite a bit below the level at which they were screaming about in the media a short while ago. The 1 year CPI is 6%, but dropping as we saw. And then if you take the longer term windows, over 2 years 6.8%, because the bulk of the high inflation months, which were in early 2021, were in the 2 year window, but not the 1 year window. Over 3 years 5.4%, over 5 years 3.9%, and over 10 years 2.7%, and this is the number that we look at, 2.7%, to smooth out the spikes. But since these numbers are lower than these numbers, the big bulge is certainly behind us, and no, inflation is not at a crisis level, even though this should get down to 3% before too long, so that this stays below 3%. I hope everyone understands the mathematics of how this works. Now we go back to my scorecard. So we looked at all three: the US CPI 10-year compound annual growth rate, the Goldman Sachs Commodity Index 10-year compound annual growth rate, by far the most important of the three, and the 10-year US Treasury yield, and we come up with 2.7%, as we saw, for the US CPI, that is below 3%, minus 1.85% for the Goldman Sachs Commodity Index. That is so low, that is far below the 3% threshold. I don't think any amount of money printing can make this above 3%, because the technonomic medium of the world, the software proliferation through the economy, makes the economy far less vulnerable to inflation, as I always speak about. That is the crux of the atom thesis, and that is why we have commodities in perpetual deflation. Commodity prices are the most important because that indisputably represents a cost to all types of consumers and businesses. Whereas services inflation, it's more ambiguous there. One can say that the price of a haircut has doubled over the last 3 years, but then the hairdresser is making twice as much money for the same amount of work if there's the same amount of haircuts over there. So his wages rose tremendously. So the customer's paying more, but the barber, the hairdresser, is making much more. So it's more ambiguous about where service price inflation should optimally be. It's not indisputable that low is good and high is bad in all cases, whereas with commodities, lower the better no matter what is an easy rule to go by. And the only one that's above 3% is the 10-year US Treasury yield. It's 3.395%, so above 3%. If this stays high for too long, then it exerts tremendous pressure on the US housing market, causing a housing bust, but that also leads to more deflation and therefore much more money printing as well. So this was our monthly inflation update, and as you can see, for all the screaming and scare tactics about high inflation, nothing of the sort is going on at all. Not everything is perfect, but it's far, far, far from a threshold where you should actually worry about inflation. It's become ridiculous. People have truly lost their minds on the subject of inflation, as I have spoken about in other videos. Now, if you like this type of content, I encourage you to subscribe to this channel. Thank you very much for watching.